Most people assume that once you hit 2 million in investments, you're set for life. You can finally walk away from work and start living the life you imagined. But that number doesn't tell the full story, because at the age you retire, the question isn't just, can I retire? It's, can I retire and spend a certain amount per month for the rest of my life without running out of money? Plenty of people with over 2 million in savings are still grinding at work. And it's not because they haven't saved enough, but because they don't know how to confidently turn that savings into income they can live on. By the way, I'm Eric Rodriguez. I'm a certified financial planner and the founder of WealthBuilders LLC. Over the years, I've helped many clients approach one of the most challenging transitions in retirement planning, and that is the shift from accumulation to income. It's a moment filled with both excitement and anxiety, and it's where strategy matters the most. So in today's video, we're walking through a hypothetical case study based on a real-world client scenario. I'll show you the framework I use to answer the question, can I retire now and spend a certain amount per month for the rest of my life without running out of money? So let's dive in. Meet Gus and Jamie. Gus is 65 and Jamie is 62. They live in California and they're hoping to retire as soon as possible. Between their real estate, their 401ks, their IRAs, their bank accounts, etc., they've accumulated a net worth of a little over $4.1 million. In terms of investable assets, they have $2.7 million. Now, you might think this is pretty solid, right? But here's the catch. They also have a goal to spend $15,000 a month at minimum in retirement, and they're planning on starting that immediately. That's significantly higher than the average US retiree. Living in California, they've got higher expenses, higher taxes, and a lifestyle they're not looking to downgrade, which I find to be very common in high cost of living areas. Folks don't want to downgrade their lifestyle. They want to maintain it or spend it in retirement. Their main concern is, can their portfolio realistically sustain their spending without running into tax traps or outliving their savings? They have received conflicting messages via their current advisor, online calculators. For instance, one calculator said they can retire comfortably pulling $15,000 a month, no problem. And another calculator said they would run out of money by age 86. The fundamental cause of their confusion and why they have anxiety is their current advisor provides only rudimentary financial planning. So leaving Gus and Jamie again feeling completely puzzled and confused. The outcome is they're overthinking and there's major indecision happening. They're stuck in a cycle of what if questions. What if the market goes up? What if the market goes down? What if we have higher expenses? What if we live longer? What if we have higher taxes? What if we want to help out our kids and our grandkids, etc.? Despite wanting and feeling like they should be able to retire, they lack the confidence to make it happen. So let's walk through their specific scenario and see what could be possible with them. The first thing I like to do with clients is run a base case scenario. So we run what's called a Monte Carlo scenario. In its short form, it's 1,000 different trials and stress tests to see what their probability of success will be in retirement. Or I like to think of it as the percentage of which they will not run out of money in their lifetime. Ideally, we like to see this at 65 to 80% at minimum. And it depends on your life plan and your specific scenario. But in their scenario right now, they're projected to only have a 6% probability of success, and they're projected to run out of money at age 87. So no need to worry, no need to panic. Let's talk about some financial planning levers we can pull to help with this specific situation. So the first lever that we're going to pull is investment portfolio optimization. So when we look at their asset allocation, the first red flag is they're in a 40-60 portfolio split between stocks and bonds, when they should really be more at a target allocation of 60-40 for their specific situation. They are extremely underinvested here. They're holding on to too much cash and too many bonds. And usually what I find, this is due to either one of two things, a lack of knowledge or a fear of markets declining. So when it comes to the knowledge part or even the fear of markets declining, what I like to share with clients is down markets for stocks, in my opinion, they come in two forms. So there's fast crashes and there's slow crashes. We believe in implementing ETF solutions that protect for fast and for slow markets. The rest of the time, our stocks are doing the big work to chase our returns with the goal to get hopefully on average 7% over time to be conservative, that should be enough to sustain a quality retirement. Obviously, the more aggressive the portfolio, the higher risk and returns you'll have. The market's averaged 10% for the past 100 years, so it would be great to get what the market gives us, but for their specific situation, we really need to only get 7% plus to accomplish their goals. So we're gonna optimize their investments there. The second lever that we're gonna do is we're gonna review their cash flow. We wanna get a really good understanding of how much are they actually spending per month? And what does that actually look like for Gus and Jamie? We want to get prescriptive. We want to look under the hood and we want to see exactly what is coming in versus what is coming out for their specific situation. And what we found with Jamie and with Gus is that they were estimating $15,000 that they were paying us, or that they were paying for monthly expenses. But when we actually ran the numbers, it was closer to 14,000. So that's another lever we're going to pull. We're going to adjust that accordingly. Now, the third lever that we're going to pull is tax planning via Roth conversions and withdrawal strategies. So by filling up the 22% brackets in the early years, we're going to help them save on taxes over their lifetime. So if we look at that initial tax bracket here, we are going to notice a few things. First off, in their early years of retirement, they're going to be in a really low tax bracket. So between 65 and let's call it 74-ish, we're going to see their tax bracket spike at 74. And the reason we have low tax brackets between 65 and 74, essentially, this is due to their taxable accounts being depleted. And now we're going to be tapping into 401ks and IRAs. So everything being pulled out of 401ks and IRAs, they're going to be taxed at ordinary income tax rates. So instead of giving them this tax bomb, we're going to pivot and do some tax planning. We took advantage of the first few years of retirement when we're in really, really low brackets. And what we're going to do for Gus and for Jamie is we're going to turn on Roth conversions, which is this green area here. We're going to turn on Roth conversions and we're going to fill up those brackets in the early years. And what that's going to do, that's going to help us increase our after-tax income as we go throughout retirement. Now, at the same time, what we're going to do too is we're going to increase our probability of success when we're doing the Monte Carlo simulation. But more on that in a second. The next lever we're going to pull is obviously they could work longer. They can work longer, maybe push back a year or two. But in my experience, clients would rather lower their expenses than have to work longer if possible. So we won't focus on that one unless we absolutely have to. And then finally, we're going to see if we can implement a robust dynamic withdrawal strategy. So when it comes to clients and how we're going to take withdrawals and what we're going to do to plan out their investments and their retirement. So typically people have the same strategy Gus and Jamie were going to have. First, they were going to pull from taxable accounts. Then they were going to pull from tax deferred accounts like IRAs and 401ks. And then finally, Roth accounts. It's a very common strategy. But what I'll show you in a few minutes is that by doing this, it might be leaving a lot of value on the table. And the thing is too, what they assumed is that $2.7 million was going to be enough, but they didn't test this yet. They didn't test for market downturns. They didn't test for high inflation, low inflation. They didn't test for spending volatility. They didn't test for many of the different stresses that we test for, healthcare, etc. So there are a lot of different variables here, but with the planning techniques that we're going to implement here, you're going to see a dramatic change in their probability of success. So when we go back to the retirement analysis and we put together these various changes, you're going to see some pretty unique opportunities here. So what we're going to do is we're going to update their monthly expenses to $14,000 versus the $15,000. We're going to update their asset allocation strategy to a 60-40 moderate type portfolio. We're going to implement the tax strategy, leveraging those Roth conversions up to the 22% tax bracket, and also implement a retirement spending strategy that is more dynamic, known as guardrails. So now when we implement this into the plan, we now have a 99% probability of success. The problem will be them underspending in retirement now. So this is where we take a closer look at the withdrawal strategy. So let's look at how their plan performs under a dynamic withdrawal spending style, aka guardrails, which is a smarter, more flexible way to spend. Instead of fixed withdrawals forever, Gus and Jamie are going to set guardrails. They're going to spend a little bit more if the market rises. They're going to pull back slightly if it were to fall. This approach personalizes spending and keeps the plan sustainable. So the next thing we're going to do is we're going to jump into my other fancy software, and you will see how small adjustments can provide more safety. So let's look at a couple different scenarios here. And the first one being, in my opinion, the most robust. And we can see what their spending could look like. So first off, we can see here that their current balance, because if they retire in a month, market hopefully potentially will go up. So now their balance will be a little over $2.7 million if their money is invested properly. And then that retirement paycheck for them is going to be $17,000. So as opposed to showing you, all the different tax buckets, as I mentioned, taxable, tax deferred, etc. What we do with this software is we just pull everything together, and we can get a sense of like, okay, our gross amount we're going to withdraw, our paycheck is $17,000. Then we're going to take out for taxes, and then this will roughly be our net income, which is right about what we need. And we're going to take $1,200. We're going to get $1,200 from the pension that Gus has, and then we're going to pull $5,200 from their taxable account. A little more than $6,000 from Gus's IRA, a little more than $4,000 in Jamie's 401k. So this is how it all breaks down here, and this is how we're going to get this retirement paycheck. Now, this is where you see the guardrails. Okay, so when the market increases, so if the portfolio increases to 2.997, then they can increase their monthly paycheck about 9%. So $1,500 more. Now their new paycheck will be $18,500. Now, however, if we see a decrease in their portfolio, then we can make some minor adjustments. And it's not as much as you might think. We only need to make an adjustment of roughly 5%, which is going to be $800 more. So we can apply multiple different changes to this type of scenario based upon their spending strategy. We can update the guardrail settings. So they want to spend more in retirement. So they are a little bit more aggressive in terms of how much they want to spend in retirement. Every client's different. Some clients have, lower expenses. They're going to spend a lot more. So that will update the guardrails as you see them here. But this is just a really simple way and a demonstration of how they can spend more than they actually think in retirement if their portfolio continues to increase. However, we do need to plan for the historical drops, and we can back test and we can see exactly what would happen if the economy has a downturn, or opposite, if the economy does well. We can adjust those guardrails depending on that year. So this is what I mean about dynamic withdrawal strategy, and having these guardrails in place can mean a great difference in your financial plan and the flexibility you have in retirement when you're spending your hard-earned dollars. And when we actually test this plan too, what we see is it's pretty aligned with the Monte Carlo from the other software that I use. We like to see this within 10% of each other. So this is a second, if you will, approval that this plan could actually work. Now, when we look at the results, when we look at how this can look for Gus and Jamie, and what we're looking at here is how, by making these guardrails impactful and how implementing them on an annual basis, how much we can save and what are the things that of value that this brings to the table. Well, we can do this here. So if we take a look at what we've done here, where we take the Roth conversions and we're filling up the 22% bracket versus their initial plan where they were just going to take taxable distributions, tax-deferred, and eventually tax-free. Because we have a dynamic strategy, we have a tax plan, their average tax rates over their lifetime, it's going to save them about 7.2% there, Total taxes will save about $1 million. Total net income goes up about $1 million. And their net legacy goes up $918,000. So what's the verdict? Gus and Jamie can retire this month. They can spend $15,000 a month and live with confidence, but not because they have $2.7 million. That's not a magic number. It's because they're building a strategy. They align their spending with a dynamic guardrail-based plan. They optimize taxes through early Roth conversions, and they adjusted withdrawals based on real data, not rules of thumb. This approach will give them clarity, flexibility, and control, and more importantly, confidence that they can retire on their terms. And here's the key takeaway. Retirement isn't just about how much you have, it's about how you use it. So what can we learn from Gus and Jamie's scenario? Well, first off, $2.7 million can absolutely be enough, but only if you align your spending, taxes, and withdrawal strategically, aka have a comprehensive wealth plan. And again, this is a client living in a high cost of living area. Could be a lot different for somebody living in a low cost of living area. Second, your enough isn't a number, it's a plan. And third, confidence doesn't come from calculators or even a person. It comes from clarity. So if you'd like to understand what your own version of enough looks like, feel free to click the first link in the description below to schedule a free introductory call with me. We'll review your income sources, spending goals, and tax strategy to see if you're on track or how we can help you get there. Thanks so much for watching, and I'll see you in the next video.